Everybody, Finance 3303, University of New Orleans, Financial Markets and Institutions, Chapter 9 on the mortgage market. So, what are you all going to think? I've lost my mind or something. I could be a little bit more excited about this chapter because it means so much to financial institutions and in banking. And I just want to state some of the obvious. Guys, what we need to do is if we're referring to like chapter 8, I'm wanting us to think a little bit differently about cash flows because that's everything in finance and everything in banking. As soon as you get paid from a loan, you're wondering when you're going to get paid the next time. And the thing about banking is you don't want people to pay off their loans. You want them to have loans for the rest of their life because that's the way you earn money. But naturally, you have to have people paying down and you have to have other people making loans. So, in between all that flurry of activity, it's a cash flow issue. And going back to how we talk about, let's say, corporate bonds, you're going to have every 6 months, you're going to have your coupon payment, and 30 years from now, you're going to get your principal back. So, outlining and hoping that we understand a little bit more, you've probably not heard about duration like we had talked about in chapter 8. And candidly, I still have to make that video. But that's one of the primary high points of a course like this. To understand duration, it's that weighted average present value of when you're getting your money back. So the calculations, again, chapter 8, we're going to segue over to chapter 9, talk about the mortgages, and just want to reiterate again. In a bank loan, in a car loan, a mortgage loan, a signature loan, anything, one, you're making monthly payments. And the payments include principal and interest. So think about it, it's the payment that you're getting is much larger than a typical corporate bond. First of all, the corporate bond has to pay you a coupon every 6 months. It is a longer lag in comparison to where you're getting fed, where you're getting money taken off the table. And guys, that goes to, from a calculation, from the mathematical standpoint, it reduces the volatility of whatever you're talking about. Meaning, if it's a loan or a bond or a stock, if you look at some of these stocks that pay a high dividend, a large dividend, and you look at the volatility under like a standard deviation or something like that, that would tend to be smaller than if you look at stocks that pay very little dividends. Some stocks like Tesla pay no dividend at all. So the volatility in those markets tend to be more. There's only one way to make money on Tesla, at least at the time of this recording, is they're not paying a dividend. So the stock is either going up for you to make money or it's not. So it's like, well, the stock meander. If you looked at like a AT&T, the stock tends to meander. It's not a high growth area, but it pays a decent dividend. And one is shaking the hand of the other, meaning that the dividend is high enough where, it's called the clientele effect. You got a certain group of people that like that, and I'm one of them at this point in my life, that like being fed regularly with money. So if it's AT&T stock, you're going to get paid quarterly. If it's a bond, you're going to get paid semi-annually. If it's a mortgage bond, you're going to get paid monthly because that's how people pay their mortgages. So I'll show you some interesting things toward the end of the chapter. So the first thing here is just going to be like making sure that our heads around what the mortgage markets are, understanding about that. I'll state some of the obvious things, but this is a huge, because mortgage loans, it's such a big part of banking. Trillions of dollars in mortgages are traded routinely because that's the inventory that's out there. So if you and you're thinking of, I've made mortgage loans before. I paid my house off some time ago, but many of you are just getting into that. You might have a mortgage now, you might be renting. But even if you think of a rental, it's the same story. It's a monthly payment that's cash flow to somebody, and it could be securitized. So a mortgage is securitized into bonds that are sold into mutual funds and other investments. So could a lease, but your lease on your apartment tends to be short term, so there's not far to go with that. You got the bulk of mortgages that are out there for 30 years. Now, people refinance them and sell their homes and move and all those things. But even the average life, Fannie Mae does a lot of research on this, as do a lot of people in academics. And it's a big part of study to say, well, really, these 30-year long mortgages, how long do they actually stick around on average? And it's 12 to 14 years. So, by the time somebody's refinancing it, creating a new mortgage, okay, well, the old one is paid off and that's kaput, and you're in favor of a new 30-year mortgage, a new 15-year mortgage, a new 20-year mortgage, depending on what the person chooses to do. So and then they start trading again. So it's kind of like I'm hoping we could stretch our understanding of this a little bit more. I know I'm continually learning about this. I periodically have to go to bond schools and stuff and learn about new products. I've been in the industry for 40 plus years. But what's coming around the corner, some of these guys get very creative about how to provide other products and services in finance, not to a person, because we're way past that. We're looking at a lot of institutional things here. But first, the personal things, and that helps us better understand, shaking some dust off of maybe something that you knew about mortgages. We'll say that on the front end, and on the back end, it's going to get far more complicated. But, I'll show you. Okay, so the background on mortgages, how mortgages markets facilitate a flow of funds. Well, because of the institutional use of mortgage markets is basically what I was alluding to a few minutes ago, that these things, because of the inventory size, get traded around the world, and it's huge. I mean, it's in the trillions of dollars. I'll let this up there, and we don't have to worry about everybody that's making a mortgage and those things. That's not what I'm so much caring about. But if you want to look at this Exhibit 9.2, you got commercial banks and savings institutions, you got credit unions and finance companies, mortgage companies, mutual funds, securities firms, insurance companies. Just about everybody has some attachment to this for all the reasons I said. And mainly it's because of that cash flow is one of the primary things, and it's long term. You can basically count on this for a lot of years to come. So that's good news. All right. Criteria used to measure credit worthiness. Okay, this is kind of old business, but that's okay. It's an easy thing. Okay, so let's say at the base level, you or I walk into a financial institution, a bank, credit union, wherever else you're going to make a mortgage. You sit down in front of somebody and say, look, I found a house. I want to buy it. I want you to loan me the money. Okay, so the level of equity invested by the homeowner, okay, we're going to talk about some kind of down payment. Depends on what your credit is, right? Your income level is going to come up at some point. That's going to be early on in the process, and of course your credit history. So between those things, it's going to either get you to the mortgage that you want, or maybe you might have to move things around, or some people want, their eyes are bigger than their wallet, so they want a bigger house. And okay, I understand why they were doing that, but sometimes they want things that they can't afford. So, okay, that's the basic things. And then if the loan gets approved, it's out the door. The person is moving in their house and is happy as they could be. Well, that's allegedly what happens. All right, so classifications of mortgages, the prime versus subprime. The prime, guys, is for good credit. The subprime is for not good credit. And then you could package those subprimes or the primes, or you can mix them together to form those bonds that we talked about a couple of chapters ago to securitize that. I think it was in chapter 7 when we were in the bond market. But I want to continue that conversation here is that, you have them securitized, you got these mortgages, and then you have them securitized into bonds that people could buy, mutual funds can buy, people could put their 401k money in these things, and they do. So it depends on what's in those buckets that are going to define what the bucket is. In other words, it could be 100% subprime, it could be 50-50 prime or subprime. So you get the picture that any combination that somebody could want to put together could be how, these investment vehicles are assembled. All right, so okay, I'm getting to things that I think matter, guys. So okay, so we got types of residential mortgages, and I think this is important to look at. Some of these, academically, I've seen like in this book and other books like it, but in 40 plus years, I've never seen them as a practical matter. So some of these, I guess, exist in name only, and maybe some of the largest lenders would have these in their policies to loan money based on this. But okay, a fixed rate mortgage is probably the one that everybody's most familiar with. This is the most typical, right? You're going to finance a $200,000 house, a $400,000 house. You're going to see what the monthly payment is. It doesn't change. The coupon rate, the rate that you're paying doesn't change over the course of the time. You keep it for 30 years. Fixed rate mortgage. Okay, very predictable because the payment is the same and there's not a lot of arithmetic that has to go in here. If you had an adjustable rate mortgage, well, okay, that starts to change the equation. We could have a difference in the rate, thus a difference in the payment, and it depends on when that resets. So guys, it might be at the end of every month. Let's say the Fed changes rates and rates start to move and the adjustment is attached to like Wall Street Journal Prime or whatever it's indexed to. And that might change frequently. It might change, let's say, at the end of the year. It might change. I had a mortgage on a piece of property I bought, and the guy says, look, we're going to finance this for 30 years, but every 5 years, your rate can adjust. Well, I paid it off before the 5 years came, so that didn't affect me. But if you were keeping it for the whole 30 years, then you've got adjustment periods every 5 years, meaning they look at it, they pull it out, pull all the paperwork out, and they say, okay, well, this year is going to change very potentially. The market has changed, so we're going to increase your rate. The market has changed, so we're going to decrease your rate. And the payment will change. So depending on, who maybe bought this mortgage inside of a bond, well, then the money their cash flow is going to be altered very potentially by some of this stuff going on in the adjustable rates. And guys, I've seen whole pools. I've seen entire bond portfolios that are made up of just adjustable rate mortgage. That means every loan in the portfolio can move around, and it might not be consistent. Again, some of them might move around potentially every month, some every quarter, some every year, some every 5 years, as I just explained. So I'm just asking us to pause and think of what that would look like. Imagine that you owned a portfolio, or better yet, you were managing a portfolio for a financial institution, and you bought these things, and you want the adjustable rate component because that hedges some of your interest rate risk. Your fixed rate mortgages, you've got all the risk that's embodied in that product. Adjustable rate gives you some movement or some latitude or some hedge to adjusting rates, especially when the rates are going higher. But just as important to consider when the rates are going lower, because if you own that, you're getting less income that are coming in. Okay, so all right, just thinking of that. Just give yourself a second to think of what that's going to look like. Or some portfolios inside of banks, you're going to have both of these. It's just a matter of how much you have in each of them and what's your coupon rate and what's your weighted average and all the things we talked about in the previous chapter. Okay, chapter 8. Okay, you have graduated payment mortgages and growing equity mortgages. They're similar, and I'll show you when we're paging through here. But guys, some people, if you think about it, when I bought my first house, it was in the early 90s. And I remembered when I said, that's a big part of my payment was $1,000 a month. Well, I was coming out of an apartment that I had a family member renting to me for $250 a month, and my payment went to $1,000. Well, okay, that was a big shift for me financially. Nothing that I couldn't afford, but it was like, Mark, it's locked in for 30 years. You're going to pay $1,000 a month. Sometimes people would say, well, and The benefit was my payment was never going to go up in 30 years as long as I kept the house and kept the loan. I was a young person, so I would definitely say I was wanting my income to go up over time. Well, every time I got a raise, that $1,000 didn't look as bad as it used to. Some people would say, why don't my payment go up with the earnings in the future? So that's what those are. Those are, I've seen them here. I've seen them in books like this, but I've never seen one as a practical matter. Very few people would want that. So it's interesting. And if you're thinking about it that way, in theory, somebody's payment could change very often. It could be monthly in theory, it could be quarterly, annually, or some other frequency. But it's like you would go in, I guess, and say, well, my pay went up. I got a couple of raises over the past couple of years. So my payment needs to adjust as a percentage of my pay. And I would start paying the mortgage down more quickly because I'm paying more on it. So you've got to think about, again, from a duration standpoint, your payments are coming in differently than they were. And how's that going to affect the duration of the investment? So you've got duration that's going to come in. The big D word is going to come into everything because that's where it's all centered around, as described when we were first talking about it in chapter 8. But if you're looking at these make up a large part of institutions' portfolios, and the duration is all over the place. So it's just that much harder to manage with people with education like you all are getting. That's where it comes in. That's you get deep into this, and I'll show you some things toward the end. All right, second mortgages. Okay, that's just you made one loan against your house, and some years later you make a second loan against your house, but you didn't want to disturb the first loan. Well, a bank or credit union will make you a second mortgage, and that might be for another project you got. You want to add a bedroom on your house. You want to buy a car. I want to use the equity in my house to buy a car. That might be a second mortgage. A shared appreciation mortgage, and I'll show you where this is, and we'll capture it in the recording here so you could see what the book says about it. Shared appreciation is the bank might own part of your mortgage, and they share an appreciation with the price of the house going up, or the price of the loan, or the balance of the loan going down. And I'll show you one of those. I've never seen one of those either in my life, but apparently they exist because they're in the book here. Or a balloon payment. Which would be you, instead of making a level payment like in a fixed rate mortgage, you make a much smaller payment. Let's say a payment would be $1,000 a month. I had a guy was buying some years ago. It was a friend of mine. He came to where I work, and he says, I want to buy a car. And it's like, okay, how much? And he says, $1 million. He was buying a $1.5 million car. He was putting 500,000 down, and he says, okay, on my million, I want a 5-year car loan. Well, you might imagine that payment would be, tens of thousands of dollars a month. So he says, do a balloon for me and just have my regular payment like $5,000 a month, even though I would normally have to pay like $20,000 a month. And then at the end of 5 years, I'm going to have this huge balance, which is going to be due. So sure enough, long story short, he starts out with the $1 million loan. He's paying a relatively, I know some of us are thinking $5,000 a month for a car loan is a big number. Yes, but not as big as it should have been. So he's paying far less than what he should have been paying, and he's going to have this huge balance at the end. Well, after 5 years, I forget all the math, but it was like he owed like $600,000 of the million at the end. And there's your balloon payment. So you can imagine these little bitty payments, and then it goes into a big balloon if you've not heard of this before. And he sold the car and paid his loan off. And that was the idea. He didn't want to tie a lot of his cash flow up in the regular monthly payments, but he wanted to enjoy the ownership, and he did. And at the end, he had a choice. He's like, okay, I owe you $600,000 next week. I could, get this car sold and get the money to you, or I could refinance the 600,000 into another loan. Yes, that's fine. And it could have been another balloon. So there are relatively very conventional ways to approach any loan, and there are creative ways to approach loans as well. So this kind of goes over some of this, and I hope you find them interesting when we're going through it. All right. So fixed rate mortgages, I'm just going to pull this up, guys. Let me do this. Fixed rate mortgages, I'm just going to let that be part of the video here, and then I'm going to move on to the next one. All right, it's going to show us examples of amortization schedule for selected years based on a 30-year, $100,000 mortgage at 8%. Well, first of all, $100,000 mortgage, this book is showing its age because that wouldn't buy you that much of anything. But I'll let this be part of the recording, and we'll just talk it through as we're going along here. Okay. All right. So that a fixed rate mortgage would just be, I'm going to, just to reiterate, I'm going to finance the house for 30 years. I want a level payment every month. I don't want my payment to change. I want to pay, let's say it's $1,000 a month, to use my previous example. I'm going to pay that each and every month for 360 months. The payment's never going to change. The interest rate's never going to change. The term is never going to change. And I could enjoy that for 30 long years on that if I never miss a beat. Some people do that. They never get out of the house that they're owning. They raise their family. They continue to pay the mortgage. They pay it off just as it should be. That would be textbook perfect. Adjustable rates, we talked about just a little ago, but that's going to be where you have some adjustments there. It's going to change the duration and possibly the term of whatever you're talking about, whatever loan it is. So there is a place for them in society, and there's a place for them for people that they could reach out for that. If somebody is, a little bit market savvy and say, you know what, I think the rates are going to fall after what we've endured for the past couple of years through the recession, not the recession, through COVID. And the way rates have changed, somebody might be betting on big changes that the Fed is going to make, and my rate's going to come down. So my interest is going to come down over the next couple of years. Better be right, or it could go up, and you could have a much larger payment. All right. As you see where it's typical for an adjustable rate mortgage, that's the way a bank is trying to sell that. Oh, I could get you into a fixed rate mortgage at 6%, but I could give you an adjustable at 4 3/4. And somebody's like, whoa, let me get that adjustable. I like that a lot better. But it's obvious that the rate can change over time, and that's what they would have to be prepared for. The lender. All right, so let's check this out. A graduated payment mortgages allows the borrower to make small payments initially. The payments increase on a graduated basis over the first 5 to 10 years and then level off. The market is tailored, or the mortgage is tailored for families who anticipate higher income and thus the ability to make a larger monthly payment in the future. In a sense, they're delaying part of their mortgage payment. You're just kicking the can down the road a little bit. So it's got kind of that, somewhat of that balloon feature in there, but not as dramatic as a true balloon. So you're seeing how that works. And guys, through all of these things, I want you to be thinking duration. When, how the payment stream comes in, how's it going to affect the term? What's it going to do to the investment if we're invested in this type of mortgage? Growing equity, similar to graduated payment previously, right? In the monthly payments are initially low and increase over time. Unlike the graduated payment, the payments never level off, but they continue to increase, about 4% a year throughout the life of the loan. With such an accelerated payment schedule, the entire mortgage may be paid off in 15 years or less because you're increasing the amount of the payment, thus increasing the amount that could go to the principal. Okay. Second mortgage can be used in conjunction with the primary or first mortgage. Okay, I'll let you read this on your own. I don't want to read it to you, but guys, it's a second claim. Okay, it's a second claim against the property, but some people want that separate. Like you've got your first mortgage that's going on for 30 years, but you've been paying on it for 10 years. So you've got a little equity in your house. Somebody might say, look, I want to buy a car, but I will use my house as collateral. I don't want to use the car as collateral. So and I want to throw in some other things. I want to borrow some money from the bank. I want to make it a second mortgage. Let's say it goes out for 6, 7, 8, or 9 years. I'm going to buy a car with it, new car, maybe two. and then I want to do some repairs on the house. I might want to buy another piece of property. A lot of things could come under a second mortgage. And they want that to burn out more quickly than the first mortgage. Okay, so a lot of times the second mortgage is a higher interest rate because the bank is saying, well, wait a minute, it's like you're leveraging up again, and we've got a little bit more risk there. If it's the same institution, like you're getting both loans from the same bank or credit union, they might give you a break on that because it's like, okay, we know you, all of your borrowing is from here, we know the house, everything is kind of under one roof, and we could be a little bit better about that. A lot of times what happens, though, people go to ABC Bank and get a first mortgage, and they go to XYZ Credit Union to get the second mortgage. The institution that's holding only the second mortgage knows there's more risk. If something happens to the borrower and they foreclose on the house, the first mortgage gets paid completely before the second mortgage gets paid at all. So that's where you say, there are investments that are nothing but second mortgages. You're buying a pool of second mortgages, and there's more risk there. So when you're buying a pool and you don't know the people and you don't know the house and you don't know the property and you don't know the location, that's a riskier portfolio. But some people like it. Some like, okay, I'll take the risk. I'll invest in that. I'll get the difference in the interest rate, and that'll pay me for the additional default risk that might be baked into the equation there. Okay, what about the duration? What about the value of the property? Be thinking of all those as we're going along. All right, shared appreciation allows a home purchaser to obtain a mortgage at below market rates. In return, the lender, providing the attracted rate, will share in the price appreciation of the home. The precise mortgage percentage of application appreciation, excuse me, I can't read, allocated to the lender is negotiated at the origination of the mortgage. So they have skin in the game, so that's a shared appreciation. Never seen one. All right, a balloon payment, just what I was talking about with the car, requires only interest for the first 3 to 5 years. Doesn't have to be only interest. It could just be a very small amount of principal. And at the end of the period, the borrower must pay the full amount of the principal, the balloon payment. All right, we talked about that one. So imagine what again, the duration here and the cash flows are very different. Guys, it's like a corporate bond. Again, they'll pay interest only every 6 months, and at the end, they owe all of the principal back. And let's say Ford was borrowing $1 billion. Okay, so they're paying interest for 30 years and then owing the billion back at the end. So if you're thinking about it, a corporate bond has a lot of attributes to a balloon payment loan. Think about that. All right. So if we were to do a valuation on the lending, guys, all it is the discounted cash flow method. So we have the present value of the mortgage, okay? And is the sum or the present value, because we have a time value element on the denominator. So it's the present value of all the coupons plus the principal at the end. And it looks sexy, the equation does, but it's things that you've already done through other courses. It's the present value of the coupons plus the present value of the principal. So the problem is, if you're looking at some of these things that we were talking about previously, it's hard to anticipate what those numbers are. If it's just a fixed rate mortgage, we could do this equation with confidence because it's like, oh, just cash flow. The others are like, well, the cash flow moves around, or in terms of the adjustable rate, the interest rate moves around and the cash flow moves around. So then this gets to be very questionable, and people that do valuation on this, it's high-end stuff, guys. It's high-end math that people are paid very well in trying to anticipate when the cash flow is coming in and how much is coming in. That's a big deal in banking, to know when these things come around. All right. All right. Risk from investing in mortgages. All right. Number one is credit risk. You loaning money to people, and some people don't pay you back. It's that simple. Credit risk. Interest rate risk. We talked about that. Anytime you're loaning money on decades on end, you're going to have interest rate risk, the risk that interest rates change. So if the interest rates are increasing, the value of that loan goes down. So if interest rates are going up, what the value, if you tried to sell that mortgage to another entity, the value of the mortgage goes down. It's bond accounting, right? Like we talked about for bonds before. Okay, so it would be the price starts dropping. In the case of interest rates going down, you lose the income off the mortgage. So you've got interest rate risk that's cutting both ways, no matter if interest rates go up or down, depending on which one of the mortgages that you hold. And guys, I'll add in right now that any consumer loan, you have a baked-in call option, use an option language, you have a baked-in call option on the debt. What does that mean? That's an academic way, that's a finance way, that's a sexy way for saying somebody could pay you off early. And it's usually when interest rates are falling, you got all these people that hold mortgages or coming to refinance them. And the bank takes an immediate hit because somebody was paying 7%, interest rates dropped to 5%. And what are they? You got the guy in there the next day. So I want to refinance the mortgage. I want a 5% mortgage. And you need to do that for them, or they'll go someplace else and get the 5% mortgage. So you begrudgingly, you get the business, okay, you try to keep the business and you refinance it for that person, but it takes the income out of the bank immediately. So consumer loans are like that. Somebody could come in and refinance anytime. They could refinance as many times as they want. And that's part of retail banking. It used to be, but that got drummed out. It used to be that there was a refinance fee. You know, there would be kind of a penalty. Somebody would come to do that. It's like, well, I'm going to charge you $5,000 for refinancing it because I'm losing some of the money. Nah, that's gone. Okay, so that competition weeded that out because you had enough institutions saying, I don't charge such a fee. And that's called a prepayment. Okay, prepayment that anybody could come in and prepay their mortgage or car loan or pay it off. Okay, so that prepayment risk is another risk that's inside of any loans to consumers because people would have the right to do it anytime they wanted to. All right, keep going. Prepayment risk, there it is. I'll just let it capture right there and I'll move on. Okay, so you could pause your recording and read what that is if you want it in textbook language. All right, so now we move into the sexier thing, guys. Mortgage-backed securities. It is a huge, that's the securitized mortgages, and they're being converted into bonds, bonds to be traded on secondary markets. Mortgage-backed securities, you're seeing that in the bold print there. It's MBS or called pass-through securities. So we talked about securitization when we talked in earlier chapters. I think it was chapter 7 on bonds. And I talked about the federal agency securities like Fannie Mae and Freddie Mac and those. You got Ginnie Mae here at the bottom of the page. Okay, so types of mortgage-backed securities. So all these loans, imagine all the different types of loans that we talked about so far in this chapter, and imagine them getting put into pools of bonds that are traded all over the world. So you go through the securitization process and you go through this mortgage-backed securities. Okay, that's the primary thing that we're going to be looking at. And guys, private label pass-through securities. If it was Ginnie Mae, it's backed by the full faith and credit of the government. But what if it's private label? Private label means pass-through securities can be formed, let's say car loans. There's nobody backing the car loans. If somebody doesn't pay, the bondholder takes a hit. And when you're buying these portfolios, you don't know who the car loan are owned by. So it's just like, well, you get more interest, of course, because they don't have any backing. But that's what private label means, that anything could be put together and securitized, any cash flow, and sold to investors and sold to mutual funds and sold to corporations. So that's where it gets interesting. This is a huge market. And guys, when since I've been in banking, you saw that market growing very steadily where, everything was on the table. There was a time that nobody put together a bunch of car loans and securitized them into bonds. Student loans, all kinds of other things, that was normal. Mortgage-backed securities was normal, but not like credit card portfolios. Okay, so just about anything that could be put together is now securitized for people that want to invest in it. Okay, so here's your Fannie Mae and CMOs. That's the ones when we finally get those. I'm going to show you what a CMO looks like. Okay, collateralized mortgage obligations. All right, so Ginnie Mae, private label, Fannie Mae. I'm going to let that be part of the recording. Not worried about this FHLMA participation certificates. Not worried about that. Okay, so the other ones above that I want us to have an understanding of. Okay, CMOs, collateralized mortgage obligations represent a type of mortgage-backed security in which the underlying mortgages are segmented. I'll read this along with you, into tranches or classes according to their maturity, and the cash flows provided by each tranche are structured in a sequential manner. Okay, that's a sequential CMO. So, guys, what happens with these CMOs is that these cash flows could be cut in any way that a person wants them cut. And what does that mean? So this is the most creative loans or investments I've ever seen. And what will happen is you'll get an investment bank that buys a bunch of, let's say they go to the Whitney and they say, okay, how many mortgages do you make in a month? Okay, $40 million a month, 50, 60, $100 million a month in mortgages. Okay, well, sell them to me. What the investment bank is doing is buying the cash flows. So you've got $100 million in loans that are paying every month. And we can keep this simple by saying, okay, they're traditional mortgages. So everybody's paying every single month, and there's a typical interest rate and there's a typical term. So what the investment bank is doing is they're buying that group of cash flows. And then what they can do with them is sell them any way they want to. And let me tell you what happened to me that was an actual, I won't go into so much the detail, but let me tell you what's happened. We got in at work, we got in some cash and we bought some loan pools, but we had some money that we were going to buy a CMO. And I had a firm that was helping me with this. And I'll give you, for instance, what this would be. And it's like, you know what, guys, on the first three, this whole thing, I want it to be like, it was like a $40 million bond, 40 million, okay? And 10 years. I want it to be totally paid off in 10 years. So it's like you're placing an order, like you're ordering pizza. And in the first 3 years, I want an unusual cash flow. I want a lot of money coming to me for the first 3 years, like payments. And then for about 5 years, I think it was like that, 5 years, I don't need much money coming in at all. 5 years, okay? And then the last 2 years, I want these huge amounts of cash flow coming in to pay me off. So at the end of 10 years, this whole thing will be gone and I'll have all the 40 million back in the interest that they owed me. Well, guys, what kind of bond works this way? None of them. So what the people at Wall Street that make these bonds, they will sell like, people are still making their payments regularly on the underlying mortgage. So when I'm not wanting the cash flows, they sell those cash flows to somebody else. Okay, you take a present value of the cash flow, and that's the price. So I was having to pay off some things in the first 3 years, and I needed the money to do it. And then at the end, I needed to pay off some other things, and I needed the bulk amount of the money coming in at the years 9 and 10. Guys, Wall Street will make that for you. Like I said, it's like ordering a pizza. You could say anything you want, and they will make it out of mortgage-backed securities. It is extraordinary. And let me show you another thing that I'm telling you about. Like, let's say you had a regular bond, okay? And you had the principal here, it's $1,000 that's due in 30 years. Okay. And it's a 10% bond, which would mean $100 a year in interest with $50 every 6 months. That's all the coupons. Okay. $50 every 6 months. 50, 50, 50. Okay. So it would be like somebody saying, this is 30 years, so you've got 60 coupons. Guys, it would be like somebody saying, okay, I see this bond here, but I'm not interested in the whole bond. This is what I want you to do. I want you to sell me the coupon right here. That one's coming out in year 6.5. 6.5 years from now, this coupon is being paid. I'll buy that one from you. Then there's another coupon up here that's coming out in year 17. Okay, I'll buy that one from you. Then there's another coupon here that's coming out in year 23, but I only want half of that. Sell the other half to somebody else. Then I want 10 of the coupons that are coming or at the last year. 10 of them coming at the 30th year. Okay, put this together for me. Tell me what I owe you. That's the ones I want to buy. So that would be crazy under a normal investment. Okay, but because somebody owns this whole bond, they start selling the parts. They'll put it together for you, they'll sell the parts. Okay, so having said that, guys, you could say, see this coupon right here? When is this one coming out? That's coming out in year 12. I just want I just want like a third of that one, a third of this coupon. Sell that to me. Tell me what I owe you and sell it to me. Well, they do the present value and so on. Look, check this out. The CMOs are sometimes segmented into interest only and principal only. So you could have a bond that represents just the coupon payments, that would be interest only. And then you could have a bond that represents just the principal only. And again, they'll put it together. Who buys this whole bond controls the cash flow and how it's sold off to somebody else. So it is one of the most interesting things I've ever seen in my life in banking, a CMO. I mean, very interesting the way those are put together. And I'll give you one more instance about this tranche business. Okay, so somebody buys a mortgage loan or several mortgage loans. Okay, so you got house loans here. All right, so I want to buy a bond that's coming off of these house loans, and we want it to be a sequential. So all this business about tranche, where did they say tranche in here? Tranche. So if you bought tranche A, you have dibs. If you would have dibs on the cash flow of this pool. You are first to get paid. And all of the cash flow of these loans are going to go to pay you back first. So your investment in these 30-year loans might only last a couple of years because they're going to take all of the payments that are coming in from all of the people that made the house loans and pay you off. So when you're on the phone with these institutional brokers, you are saying, well, okay, this whole home loan pool, I like it, but I'm not investing for a long time. I will only invest, I'll send you $10 million and I want all my money back in 3 years. And what will they say? Okay, we will divide this out. We will take all the payments that are in this group of loans, might be 100 million in loans, and we will pay you back evenly. So at the end of 3 years, you'll be done. If you didn't consume all of the cash flow of these, okay, they got more money coming in here. They paid you what they're supposed to. Where does the other money go? Oh, to the B tranche people. They get paid next. So they might get paid over the next 6 or 7 years. What next? Then you got the C tranche people. They might get paid back over the next 8 to 10 years. And away we go. So somebody could buy, guys, the Z tranche, Z. You get paid at the end. You don't get any money until everybody else has been paid off. So that would be the sequence, and they're paying off the tranches one by one. And then the people at the end, everybody's going to get paid. But it's just a question of when you would get paid and how much the payments would be. So think about that from a duration standpoint. Think about that at how that investment would look. And I'll show you at the end on the Bloomberg financial system, and each of you all need to know what that is, at least in conversation. Bloomberg is a guy, he was a mayor of New York, but he's a multi-billionaire. He created the Bloomberg financial system, and it is second to none on earth. Anybody that's got a Bloomberg terminal, I have one at work, you could rent one yourself. They're $1,000 a month, and you could have a Bloomberg terminal sitting at your house. I don't know what you would do with it. I mean, but you would have access to the most unbelievable financial products that you've ever seen, and it would be hard to even decipher what they are. I'll show you one toward the end of here. But this is the life of CMOs, guys. So you can. That's when I was saying, I want a lot of money back in the first couple of years. I want you to skip some years, and I want you to start paying me again. To the guys that put together these CMOs, like, yeah, no problem. I know exactly what to do with the rest of the money. It's they know what to do with the rest of the money, and they won't even tell you about it. That's none of your business. Okay, you want something that pays in a very peculiar way? Well, it's peculiar to a regular bond that we're normally taught in school, and we normally talk about, but it's not peculiar to them because that's what they do. And they buy all of these home loans or corporate bonds, and they own the cash flow, and then they could part that out in any way they want. It is very cool, all right? Okay, before I get myself too excited, let's keep going. Okay, so there's some mortgages also sold through collateralized debt obligations. And sometimes these CDOs, guys, are loans that aren't mortgages at all. So CMO, collateralized mortgage obligations, those are mortgages. And you're seeing collateralized debt obligations became popular in the late 90s. By 2007, the value of CDOs was 500 billion. They're in the trillions now, I'm sure, but it could be any debt. Okay, so you could have car loans in there. You could have, anything, any debt that can be put together. These guys can put them together and sell them to other people, and depending on what your use is. And I want to add, make sure we're understanding that whatever's going in these buckets to be sold, it's what credit rating are they? What kind of risk am I taking on? Do they have the backing of like a Ginnie Mae or a Fannie Mae, government backing, or there's no backing at all in the case of a car loan or securitized, credit card receivables or any kind of receivables. Companies that sell things and they have, they finance their own product, like back to car loans, it'd be like General Motors, GMAC. Okay, so if you go buy a Chevy, the dealer will say, I'll finance it for you. We, the company, will finance it for you. So that would go to General Motors Acceptance Corporation, GMAC. Well, sometimes they got too many loans on their books, or sometimes they want to move something around. Or it's like, okay, we got too many of these 4-year loans, or we got too many of these 7-year loans. And how do we get rid of them? Well, we can securitize them. Call Wall Street, they'll put them in bonds, and they'll sell them all over the world. We're going to get our money back very quickly. So that's it. It gets about as creative as we can have it. All right. So guys, the valuation of mortgage-backed securities, the present value, think about it over all that we've said. It's reliance on the ratings to assess the value. Even when you go to Moody's and Standard and Poor's and all that stuff, that doesn't do anything for the cash flow. So it's the value of mortgage-backed security, the value of any of these is the present value of the cash flows, and it gets very difficult with some of the things that I just described. Okay. going into the mortgage credit crisis, all that was happening there, it's getting further and further away every day that passes. But guys, in 08, 09, what was happening is financial institutions were securitizing bad loans, and they would package them together and they would sell them off. And it's very difficult for people on the other side of it to really know what's in the bucket. And especially if you're misleading people, if you're saying all of these are good mortgages, all backed by Fannie Mae, and they weren't good mortgages, all backed by Fannie Mae, well, um, a lot of those institutions got sued. A lot of them went out of business. So that was a problem. So that was fraud. That doesn't need to be done ever, and that was happening. So the impact on Fannie Mae and Freddie Mac, I mean, they basically went out of business, guys. They had so much that they were, some of the private insurers went bankrupt, exposing the institutionals, investors holding the mortgages to major losses. So that was a big deal back in 08, 09. That was a tremendous deal. That, in fact, that caused the Whitney to go out of business. The Whitney was forced to merge, Whitney Bank here in New Orleans, a 100-year-old bank. They got ahead of themselves. They bought a lot of these mortgage-backed securities, and a lot of the banks that were in Florida, where a lot of the losses were coming from. Now, they were getting things at a much reduced price. So let's say you had a mortgage that was on a $200,000 house and you're buying it for $80,000. You think, "Whoa, this is fantastic." If we're paying only 80,000 for the 200,000, when the person pays back the 200,000, we'll make 120,000 on that mortgage. Well, what happens if somebody didn't pay anything back? So they lost the 80. That's what was going on in a major way, and that's where it caused the bank. The losses were so great they merged into Hancock. Okay, funding problem. It was a mess, guys. This was happening all over the world. Okay, so the government had to come in and rescue Fannie Mae and Freddie Mac. I'm not worried about that so much. What I was explaining before is what I'd want you all to get out of this chapter. Okay, so the systemic risk due to the credit crisis, that's where it was systemic. It was throughout the banking industry, because no matter what you owned and how much you think you knew what you owned, there was a lot of, you know what, I really didn't know what I owned. I thought I owned something better than I had. So it was a lot of those CMOs that were blowing up on a regular basis. So that was a big deal. Okay, so who's to blame? I mean, we're not going through all that type of stuff. Let me get to the end of this chapter and I'll show you another. The financial institutions that package together the mortgage-backed securities. Okay, it depends on how those things are put together and what's put in there. So even on the best day, guys, you would have to know what CMO you're owning, because that would be the most or one of the most creative products that will come out of Wall Street. And just taking the mortgages that we learned about on the front part of this chapter, imagine somebody saying, "Well, I'm going to create this derivative, this bond derivative, and have all those different mortgages packaged into one." Well, if somebody said, "Well, gee whiz, what is my cash flow going to be?" And somebody could say, "I don't know. I have no idea." It matters, who's defaulting and who's not, and what's covered and what's not, and where the interest rate's going to go, and how many people are going to refinance their loans, and how many people are going to change some of their terms. And it's like you come out the other end and you like, I have no idea what this thing is going to look like. And those things are sold. Okay. So let me show you. I'll show you what this is too. Conclusion and blame. We won't have to go through much more. Let's see. Okay, there's a summary. All right, so let me show you something else. All right, so let me go into share, change the screen here, making sure. All right, so guys, here it is. Here is a CMO. Okay, so here's one that it started out in 2016. Okay, and it was a $35 million pool. You're seeing it right here. And 100% of the pool is left. Okay, you're seeing that. Let me get rid of some of this ink and I'll show you a little bit more. So this This is testable information. All right, so you got a particular CUSIP number. If we had a look, this is off the Bloomberg system, like I was telling you all about. Okay, so it would come with a very unique CUSIP number, so you could pull this up on a system like Bloomberg. You can't pull it up anywhere else. And it is a 2% group of loans. That's what it looks like to me when I'm looking at this. So again, this is a CMO. So you know it could be divided up into an infinite number of subdivisions, and it's just a question of what piece you're buying when you look at one of these. So the investment bank would send you this screen and then say, I've got a brand new pool. It's 35 million. There's nothing been sold yet. 35 million was the pool size, and 100% of it is available. Tell me how much you want. And that's the way you would say, okay, I want $1,306,242 of this. Why that? Because that's what I want. Okay, we'll sell you what you just said, that piece. I can't even remember what I was saying. We'll sell you that piece of this pool. And guys, it might be that is it a sequential? It doesn't look like it because usually it would say sequential somewhere in here. So it's like, okay, everybody might get paid the same way. I'm not sure that they are, but let's see what happens and just focus on for right now. It's a 2016 pool that's coming out. So here's the price. It's trading at 99 and 29 30 seconds. Why? Because that's the way the bond market does things in 30 seconds of a dollar. And what we see, it's in 30 seconds of a unit. And what we have to see on the piece that you bought is right now you're at what I call a zero bubble. Okay, we're at a point in time to where interest rates haven't moved. Now, what you have to do as a bank, you have to shock this security. What does that mean? You have to tell me on the Bloomberg system what's going to happen to this investment if today we come off of today, and what happens if interest rates go up by 1 percentage point or 100 basis points? What happens if interest rates go down by 100 basis points or 1 percentage point? What happens if 200? What happens if 300? So you got 6 shocks. And this is all subject to the advanced mathematical modeling that's going on behind this thing. So the Bloomberg system would say, here's your shocks right here, guys. Here's your up 300, up 200, up 1. Here's your -1, 2, and 3. Here's your 6 shocks. So what's going to happen here is a 2% pool that is today paying you yield to maturity at 2.005%. You get a little bit extra because you bought this at a little bit of discount from the face value. It's not 100%, it's 99 and 29 30 seconds. Well, how this would appeal to me in banking is I'm quickly seeing on the yield table. Okay, so it's yield table right here. I am quickly seeing that under all 6 shocks, my yield is barely changed. That's good news. It's very stable under all 6 shocks. Okay? All right. Now, when interest rates fall, people usually start to refinance their loans. So that means you're going to get your money back more quickly. When interest rates rise, you get what's called extension risk. People don't prepay their loans. So what you thought right here, look at the average life and the modified duration, something we talked about in the previous chapter. It's got to be spelled out on here. So if you're starting with the average life of this investment is going to be 1.79 years. It's not going to be out there for a long time. This has got, it's got a legal maturity. Yeah, right here, guys. Legal maturity of 329 months. Okay, so there's a lot packed in here. I'm not going to ask you to be experts at this, but this is, this is going out for basically the better part of 30 years. But you've got a piece in this pool that's only going to last 1.79 years as an average life. So you're going to get paid back fairly quickly. Modified duration is going to be 1.73 years. So you're saying, okay, I'm happy, right? Half-life. So from 2016, now watch this. Let me get rid of some of this ink. As you're going to get paid back between the fourth month of 2016, that's when it comes out. So you're going to get paid back from April, okay, of April to September of 2024. That's the payment windows you see in these date windows of when you're going to get your money back. And it's going to be subject to some level of fluctuation. All right. If interest rates go up, it's going to extend. And you're going to get paid back now maybe as far out as 2033. So you got extension risks there. Do you want to own this pool out to 2033? If you don't, you would tell the institutional investor, I don't like this. This is not good for me. I want one that has payment windows that are very customizable for me. And they'll find it. They'll get it for you. That's their job. This is what institutional investors do, or the Wall Street side of this. They are putting these together for you. If interest rates go down, you could expect people to refinance their mortgage, pay them off more quickly, and look, this thing will be over in no time. Look at the payment window. I just wrote over it. It's going to be over with in the year 2020. So you're already at 2016. So in a couple of years, the whole thing will be gone. Guys, you see what's happening here? So you're buying expected cash flows, and they have to be shocked by regulation. This is a federal regulation that if you were in a bank, you'd have to show this screen to an examiner that would come in. He says, oh, I see you bought a CMO. We're nervous about that because of the ways that these things could be assembled. We don't like them. The government will tell you, but there's a way to buy them. So as long as you're fitting this and are able to explain this to the examiner, because they would ask you very simply, okay, I see you got this. You bought a piece of 1,400,000, whatever it was. Tell me why you bought it and why this makes sense. And you would go through what I was just explaining. You would tell that person they're familiar with what I was just explaining, but you would say, well, why am I buying this? Because I wanted a fairly short-term security and the yield made sense for me, whatever that means. It made sense at this point in time. And we wanted to buy something that resembled this security, and they made it for us. Okay, so this is not the only thing. So I'm going to show you there's a second page. All right, so then on the back of this page, same security, I would roll this up. Okay. This is the same loan, and here's the prices. It's like, I know this looks like a mess to you, but it will make a little bit more sense of it. So guys, here's your shocks. Up 100 and down up 1, 2, and 300, down 1, 2, and 300. It's got 3 tests that it has to pass, and apparently this one has, because as strange as that is, they put it on the Bloomberg that it passes. So that's a quick way to look at these numbers and see that it passed all 3 security tests. That your weighted average life on this test number 2, your weighted average life, the max on the downside of interest rates couldn't drop more than 6%, and they didn't. On the upside of interest rates, it couldn't extend more than 4%, and they didn't. Okay, so you're seeing where, guys, you're seeing where this passed. First of all, on the price change, the maximum was a 17% price change, and it passed all. This one got close. This one, the price was going to drop by 12%, but it passes. So, guys, you're seeing one thing I neglected to say the past screen. This PSA is called the prepayment speed. And the bigger the number, the faster it's going to pay off. So when interest rates drop the most, you could expect the prepayment speed to rise, and that's where the weighted average life fell significantly. Okay, and the maximum weighted average life for this test couldn't go above 10, and it didn't. So it passed. If all of these things are working and it shows you a weighted average life graph, when does this thing, what we used to call at work, it says, when does the bond blow up? Well, it would blow up if the prepayment speeds would fall way far below 300, and these prepayment speeds right here would fall below 300, and then this would potentially extend further than what I want, and that's why it's red. So they show you a graph. What's the worst that would happen? This thing might become a 9-year security. So you would have to say to the examiner, well, it passed all the tests, and there was no indication here that it would go to the 9 years. But it's that's theoretically a place where it could go. But Mr. Examiner or Mrs. Examiner, it passed the high risk security test. So I bought it. And this made sense to me. And it's like, whew, I'm exhausted explaining this to somebody and why we bought it. But guys, you might have a portfolio of CMOs. This is one bond. And you might be buying, 20 bonds or 200 bonds. Well, all of them with very different characteristics. Let me show you one more, and we can come to a close on this material. But this, guys, this is the part that nobody will show you in college. This is the part that I like to bring into my class, and it's hard to get these Bloomberg screens, but I have a Bloomberg term, so I could do it, but anybody else couldn't necessarily do that. So I'm not like, sitting on top of the world or something. It's just, this would be retail banking if you're doing investments, and some people, have come up to me over time and say, oh, I want to do the, I want to be in investments of some things. You wouldn't dream of something like this being in your day-to-day world. And this is, check this out. This is one page of 17 pages that you would get off the Bloomberg screen or the Bloomberg system to explain this security. So you've got, this is the beginning. This is the first couple of pages, and it'll get you far along, but you've got the other stuff that's behind, like where are all the loans? So there's a place where it would say, well, a lot of the loans are in California, a lot of the well, it's spread all over the country. It's, all kinds of things would go into here. So it just goes on and on about what the ingredients are inside of this CMO. All right, so I'll show you another one. All right, this is a different one. So let's see what this is. Okay, is this another CMO? Yes, it is, sequential payer. All right, so we know what that is. It's 2013 and is a 5.5% pool coupon going out to 2023. So it doesn't go out there very long. All right, so let's see what happens. It's an $18 million pool. Oh, this might have, I'm a little bit confused about this, guys. So it's taking me back on this. It says 2003 here. So I'm wondering, I don't know. It's got me stumped on the short run here. I'm looking at 2013 here, and this is 2013. So I don't know if it was something that for 10 years it sat, like an interest only or something like that. Because it's a sequential, a lot of that would come to my mind. All right, so we're looking at a piece here. You could buy the whole thing for $18,073,000. Okay, so it's sold at a significant premium to face. Right? So at the zero bubble, you've got a 5.5% coupon, and you're going to get 1.7% yield to maturity. How come? Because you're paying such a premium on that. Now, on your shock, it's going to go from if you got extension here, you're going to make 2.7% on this. And what's the worst that would happen? Well, if interest rates fell 3 percentage points, you're going to lose money. So that wouldn't be, the examiner wouldn't like to see that. But here you've got, this could be very volatile. And the prepayment speeds, look at what happens with this. The PSA goes from 299, okay, in the middle, and it speeds up a lot when interest rates, excuse me, it speeds up a lot when interest rates go down. It slows down a lot when interest rates go up. And look at your average life and your modified duration. You got to pay attention to this down here. So that it doesn't look like it's changing so much. And the payment dates, guys, all of them in 2023. Okay, so everybody's going to get paid before 2023, anybody that owns a piece of this pool. So apparently you're in the sequence to get paid out until 2023. So it's closer to when this particular pool matures. Does it pass the high risk security test? Let's see. All right, it's a little bit different. It does pass very quickly looking at this. You've got your shock test here. It seems like it passed the weighted this test number one, okay, on the maximum weighted average life. As the weighted average life changes and as the percentage of the bond changes, it passed on everything. You see a little bit different graph here. So it's kind of curtailed in between these two red areas, right? Where the weighted average life could extend or it could get paid off even more quickly. But there would be another example of a CMO. It's a sequential. Part of the other 16 pages, what we're not seeing, and I wouldn't bore you with this, is more into, what tranche do you have and how does it work? What are the cash flows? How am I getting paid? When? How big is it expected to be? You got all that stuff that's going on in these Bloomberg screens, in these bond derivatives, guys. So this is, again, we're close to ending here, and I know you're glad, but if you're buying a generic bond, the simple bond that we're taught when we're first learning about bonds, imagine what people could do with that behind the scenes. They're going to take that cash flow that's so dependent on, it's like, oh, this is very plain vanilla. It's going to be, in the case of a corporate bond, they're going to pay me a coupon every 6 months and then the principal at the end. They could be far more creative with mortgage bonds because as those are monthly payments. And then you have to worry about prepayments and all those other things that we discussed earlier. So how creative could somebody be? About as creative as you can get. And it's just a question of somebody going through this. A person would never buy one of these for their I couldn't imagine somebody buying one for their portfolio. Maybe multi-billionaires with very sophisticated portfolios and people to run those portfolios would say, for some reason, this is good for this person, to buy a CMO for them. And it might be they run a business, they're wealthy, and it's a big business where the cash flows, they come in spurts. They have a lot of investments going out and they have a lot of money coming in. It's just a question of when they come in and how much comes in. So you could match that off the demands for your cash with the cash coming from your investment. So they match off very easily. And how would you do that? Well, you'd go to one of these people that put this together and say, look, Bob or Joan, this is what I need. This is when I want the cash flows to come in. Guys, what you're seeing all this past business, that's if you're in a regulated financial institution that you're heavily examined and people want to see what you're investing in. If you're an individual, you don't have to justify anything. You could buy one of these for yourself. Again, why you would do that, I don't know. But again, people with large portfolio corporations that don't have to, they're not regulated on their investments. So could Ford Motor Company buy one of these for some reason that they have within the company? Of course they could. Okay. Okay, enough said. Where we'll stop. And guys, that's the world of CMOs. I just wanted to bring that up. Hope you kind of enjoyed that. Sometimes our heads can explode, and that's okay. And part of your learning. So thanks for watching.